Hello, friends. How are you doing today? Uh, we'll continue our series on finance and economics topics. Today we are going to see the capital structure. So this is an old and classical topic in finance and economics. Right? So the capital structure is the mix of financing, right? Whether you use debt or equity or some mezzanine financing alternative, right? Preferred stock, warrants, and some other things. So it has been researched and it has been studied for so many decades, maybe for the last 2 or 3 decades. Uh, because the academics and also practitioners want to know or want to find the connection of the capital structure policy or capital structure decision and the value of the firm. Okay, so I'll go into my slides. Okay, so uh, the the main interest in every organization, or in other words, like the main goal of an organization is always to maximize its value, or maximize the value of the firm. Right? And we know the value of the firm is a function of the is the present value of future cash flows, future free cash flows. So we have free cash flows in the future. So in period one, two, three, four, five, and so forth. And the future free cash flows are discounted back at the cost of capital. Right. So uh, again, value of the firm is basically the present value of future cash flows, right? And again, the future cash flows are discounted back at the cost of capital. And we have discussed this in our previous video. If you want to gain a deeper understanding on the cost of capital, please watch that video about the cost of capital. The cost of capital is essentially the required return by investors. So the free cash flows uh, in the future are discounted back at the required return by your investors, right? So why is capital structure theme or policy interesting or attractive to, again, academics and also entrepreneurs and executive? Because again, uh, we have research, it has been researched and believed that uh, the capital structure is connected to the firm value, or you could say many studies in the past have found the connection or the relation between the capital structure and the value of the firm. Okay, and cost of capital here, cost of capital. If we only have two components, right, cost of debt and cost of equity. So RD is the cost of debt. Right? Cost of debt is the required return by creditors, and the RS is the cost of equity, a cost of stock. So this is a required return by the stockholders, right? And each of them is multiplied by its respective weight, right? And remember that the cost of debt is tax deductible or is given tax discount because of its function or its service to reduce tax payment. Okay, so uh, we'll see the again the capital structure decision. Uh, Again, we have been trying through our research and uh, experiments and also observations and experiences in in the business world, like to see the again the relation between the capital structure and the value of the firm. But before that, we'll see business risk, right? So business risk is a natural part of doing business or being an entrepreneur. You see, so this is an uncertainty in your operating profit, your net operating profit after tax, and also the return on capital and some other operating indicators. So business risk is again a natural part of doing business. So no matter what capital structure you're choosing, be it 100% debt or 0% debt or 50% debt, 50% equity or any other combinations, no matter what you choose, you'll still be faced with business risk, right? Because this is just natural, natural risk uh, that has to be handled, has to be managed by an entrepreneur or an executive, right? So we see some factors here that could engender business risk. Something like this, right? Uncertainty about demand, you never know, right? Demand suddenly drops, demand might skyrocket at one time or some different events, right? And you see recently the demand for oil has plunged, right? Making the price close to zero, and even some futures contracts for oil have turned negative, something like that. So the uncertainty could be very big, right, for certain commodities or certain products. So we never know. This is part of the risk of doing business. Or maybe this one uncertainty about output prices. Also, you never know. Maybe competitors' products are coming and uh, they're better technologically. Uh, Maybe they're cheaper, right, and everything. So uh, that would suppress the price or the prices, uh, and again creating uncertainty in our revenues because of the output prices. Then uncertainty about input costs. This is also very real and it is even prevalent right now. You see, since China was struggling with the healthcare crisis because of the virus, many factories have closed temporarily. And if we need the inputs from those factories, then we have to wait for a while because of the ceasing of their productions, right? So this could be uncertain because of certain events or force majeure situations such as this, right? So you never know. And then product and other types of liability. This might be more apparent in some countries, whereas in some other countries, this might not be, this has yet to be a big issue. So you see like the recalling of something, right? In some countries, the recalling of cars or certain products are quite extensive, right? Because they try to prevent themselves from suffering or from paying a lot due to the injuries or liabilities they have to be responsible. Right? For example, if we find that we have brake problem, right, in the cars that we have produced, then we'll try to recall the cars before something happens, right? Because if the cars that we have produced and sold injure our customers, then most likely we will be sued, maybe in a class action. So in the court, we'll be, sentenced to paying a lot of money to our customers. So this kind of problem, right? And not only to customers, potential injuries to employees have to be managed as well, right? Because if we don't have the safety rules or procedures, and our factories or the production activities in our factories injure our employees, then we might have to pay a lot of money, right? Because of the liabilities. And then, so this is interesting one, degree of operating leverage. So this is a specific term in finance. Degree of operating leverage, or DOL, is defined as the level of the usage of fixed costs, right? So the level of fixed cost use. So I think we can talk more about this, right? The degree of operating leverage, or DOL. So you can imagine if you use a lot of, or a bigger proportion of fixed costs, what is the main benefit there? What is the definition of fixed costs again? The fixed costs are costs that don't increase anymore as long as we are still in the, we are still within the production capacity that has been set, right? Because of the cost. So you could imagine if we have fixed costs, then uh, we don't experience an increase in cost anymore, even if we increase the production, right? Increase the outputs of our products, right? So you could imagine this would be fixed cost for anything, right? Maintaining your equipment, maybe, right? So whether your equipment is used to produce uh, 20 items or 30 outputs per day, or 8, or even 0 or 100, so we still have to incur the fixed cost, right, for maintenance, right? So you can imagine if you have the room for maneuver, then this would be quite beneficial and profitable, right? Because if your production right now is only 8, and actually the maximum capacity is like 30 a day, then you still have the chance to increase from 8 to 30 without increasing this type of cost, maybe maintenance costs or something, right? Or yeah, any other things that, yeah, that you could imagine, or maybe in the training, right? In the training, we would hire a trainer, right? An instructor or facilitator. Then the instructor would be paid, let's say per hour or per day, right? So if we fill up the training class with 5 people, and then we add like maybe one more person, three more people, and so forth, we will not we will not experience an increase in uh, the instructor's cost, right? But of course, within the same in a certain level of capacity, right? For example, if the class uh, can contain like maximum 50 people, then by increasing from like 8 people to 30 people or 50 people will not increase the cost for hiring an instructor or facilitator. So you see the benefit of the fixed cost, right? Uh, so within a certain level of capacity, this kind of cost will not increase again, even if we increase the production activity. Right? So what is the downside or the disadvantage of using fixed costs, especially if you use it or you increase the proportion too much? Of course, the danger, right? The danger of using fixed costs is that now you are tied to a high level of cost. If you cannot catch up your production, catch up with the desired level of production, then you have to pay a lot of money because of uh, the fixed cost, right? So now you can imagine again coming back to the maintenance cost as part of fixed cost, for example. Uh, so if you don't produce anything, then definitely you lose a lot of money because of the cost, right? This is something that you have to pay, whatever level of production you're having right now, or you're producing right now. So if you produce more, it means that the cost could be spread out more evenly, right? So if you could produce, for example, again 30 a day, 30 units per day, then this type of cost would be nicely spread out. However, if you cannot produce that many units, or you cannot sell, you know, as expected or as desired, then again the level of profitability much lower because you have to bear the fixed cost, right? And another example would be again in a training example, right? You hire an instructor, and you can only recruit, for example, 5 participants, or you only ask like 10 people of your 10 employees to join the training. Well, you have paid an expensive instructor, then the cost would be very high, right? Could imagine. So, in other words, if we have a larger proportion of fixed costs, then we have to make sure that we could catch up with the production and also the sales, right? So, the more able we sell the products, the more able we are to cover the fixed costs. Otherwise, no, the proportion of the fixed cost would be like a big burden to our company. Okay, so see the figures here, 2 figures. So the first example, this one, if the fixed cost is at this level, so this is like the revenues line, and this is the total cost line. The total cost consists of fixed costs and variable costs, right? So if fixed costs are the costs that don't change anymore, even if you increase the production level of production up to a certain level, like up to a certain capacity, so they don't increase anymore. On the other hand, variable costs are costs that increase together with the level of production or sales that you are doing, right? The variable cost would be the hourly cost of anything, maybe electricity or yeah, some other utilities or hourly workers, right? The Yeah, hourly workers that we hire or something like that, right? Or the raw materials that we are using and so forth. So you see here in the at this level of fixed cost, this would be our profit, the blue one. So see here. So the total cost, right? This is our fixed cost, right? The total cost will increase uh, because of the variable cost, right? The increasing variable cost will increase the total cost as well, because the fixed cost is already fixed at this level, right? So the second figure, right, the right-hand figure shows a higher level of fixed cost use, right? This one. So higher level of fixed cost use, and you can see that the uh, now the portion of variable cost is lower, right? So again, the total cost only increase because of the variable cost, right? Because the fixed cost is already fixed at this level. So you can see, right? If you are good at again producing and selling the product, actually the potential to get profit is higher if you use a higher fixed cost. Right? This is easily imagined, right? Can be imagined easily. Uh, like the previous example, if you have a certain level of fixed cost and you can produce more and more, and you can sell more and more as well, up to your maximum capacity, then of course the fixed cost would be spread out, right? Because you have uh, a lot more output, so the cost per unit with respect to fixed cost would be lower and lower, right? On the other hand, variable costs will increase, right? Will increase with again with your sales and with your production or sales. So if you sell more, or at least you produce more and sell more, the variable cost will also increase, right? So, what is our summary here? If you use a lot of fixed costs and you are good at producing and selling, right, uh, to the maximum capacity or close to the maximum capacity, then actually you are good at making profit there, because again your cost becomes cheaper, right? The fixed cost component becomes cheaper, right? Because it is spread out to a lot of outputs. On the other hand, right, if you don't sell well, right, if you have a high level of fixed cost but you don't sell well, then what's that? The unit cost, again, the component of fixed cost in the unit cost would be very high. So this is not good, right? So this is a situation where you can say like higher risk, higher expected return, right? By using like a higher level of DOL, or degree of operating leverage, right? Or the degree of using fixed costs. So again, if you don't produce and sell well, right, then the fixed cost will be a big burden to you, because these are the costs that you have to cover no matter what, right? So if your sales are not enough, right, then the fixed cost will still be the same, and you'll bear that amount of cost, right? And when you spread it out, or you allocate it into the number of outputs, then the unit cost will be still high with respect to the total cost, with respect to the fixed cost. Right? Okay, so maybe we'll see before we see an example here. Maybe from your quantitative methods, you have studied this as well. This is a formula to determine the break-even point. Right? Here's the break-even point. So the quantity at which you would break even is a function of the fixed cost, right? Fixed cost divided by uh, the price per unit minus variable cost per unit, right? So see an example here. Thought the fixed cost is 200, maybe 200 million, 200,000, right? Price per unit is 15, and the variable cost per unit is 10. So you could estimate the break-even quantity as, again, the fixed cost divided by the price per unit minus the variable cost per unit. So the price per unit minus the variable cost per unit is often called no the we call it the margin here, right? The contribution margin, right? So the price per unit minus variable cost per unit, again, is usually called the contribution margin. So fixed cost divided by contribution margin per unit. So it is estimated here that the break-even quantity is 40. So you can determine this from all of your outputs, right? By knowing the fixed cost, and then the variable cost, and the price per unit that you plan to sell the product. So this is usually studied in your cost accounting or management accounting, right? The details of cost allocation, determination of unit cost, and something like that. Okay, so we have seen the business risk, right? Business risk. And now we'll see financial risk. Okay, the financial risk. So if business risk is dealt with by all executive and all entrepreneurs, because that's the natural part of doing business. Now, financial risk is the additional risk that comes up because of the use of debt. Right? If you start using debt, then now you have to face the financial risk as well. So if you don't use any debt, right, zero debt policy, then you are only faced with a business risk, right? But if you start using that, again, now you have an additional risk called financial risk, right? So this, again, additional business risk because of the use of debt, right, or borrowing. You start borrowing money. So we'll see a simulated example, right? Hypothetical firms here. So firm U, this is unlevered. Unlevered means you don't use any debt, because debt is frequently called leverage. You know, this is a terminology in physics, right? Leverage, to leverage something, to lever up something, or to lift up something. Why is debt, borrowing called leverage? Because debt or borrowing could leverage our profitability. So we'll see in our example, right, how the use of debt could leverage or could lift up profitability. That's why this is called leverage, right? So unlevered firm, and the L is levered firm. So firm with leverage or with debt, right? So you see difference here. Okay, so firm U, unlevered firm, has a capital of 20,000 or 20 million, maybe in thousand. Right? So unlevered firm has no debt, right? No debt, zero debt policy. Whereas the levered firm employs $10,000 debt, right? And the cost of debt is 12%. It's known here, right? It's informed that the cost of debt is 12%, right? And you see here, because total capital, again, we talked about capital in the cost of capital video. Okay, so we have liabilities and equity, right? So almost all of the items on the right-hand side of your balance sheet are capital, almost all. So assumingly, this is all in this example because of the simplification that we are using to prove a point, okay? So if the debt is zero, it means that out of the 20,000 capital, all of them comes from equity, right? Because it has zero debt. Right? Okay, and then the tax rate is assumed to be 40%, the highest tax bracket for a corporation in the United States. And operating profit here is 3,000. They have the same operating profit. So their operating performance is comparable or similar, right? And its NOPAT is 1,800, right? See the NOPAT there. And what is NOPAT again? NOPAT is EBIT minus tax, right? That's why we call it the net operating profit after tax, right? And EBIT is a representation of the operating profit. They are not exactly the same, but it's close representation, right? So earnings before interest and tax or taxes, right? This is again the representation of operating profit, right? Minus tax, then we get NOPAT, right? So we can prove it here, right? 3,000 minus 40% of 3,000 is 1,800. And similarly, this one, right? So 3,000 minus 40% of 3,000 is 1,800, right? Okay, and then the return on capital or return on invested capital. This is NOPAT divided by our capital, right? So NOPAT divided by capital. And the NOPAT for firm U is 1,800. 1,800 divided by 20,000, right? 9%. And likewise, this one, 1,800 divided by 20,000. So we have two comparable firms actually, except that firm U is unlevered, so it doesn't employ any debt financing, whereas levered firm L, is using 50% debt of its capital. Okay, so now let's see what is happening to their profitability levels. Okay, so from you again, from the story here, we know that their operating profits are the same, right? 3,000. But firm U has no debt, right? Because it has no debt, it pays no interest expense. So this is the EBT, yeah, earnings before tax or taxes. And then these are the taxes, right? 40% highest bracket again. 40% of this, 40% of EBT is 1,200. So the net income would be 1,800. 1,800. From L, same thing here, same operating profit, but now it has to pay 12%, right? The interest rate is 12%. 12% of 10,000 is 1,200. So the EBT is 1,800 minus the tax payment right here. 40% of 1,800 is 720. So the net income is 1,080. Okay, so firm L has a lower net income because it has to pay the interest expense. But let's calculate now again the ROC. What is ROC again? Return on capital, right? It's NOPAT divided by the capital, right? Your capital. So let's check again for firm U. What is the NOPAT? NOPAT here, 1,800 divided by 20,000. That's why it's 9%. Okay. What about the firm L? Firm L is 1,800 NOPAT here divided by its capital or 20,000. So also we get 9%. So the return on capitals are the same, right? Same level. What about the ROI, right? Return on equity. So return on equity is net income divided by equity, right? See the name, return on equity. So net income to equity. That's why we call it return on equity, right? So return on equity, the net income is here, 1,800 for firm U. 1,800 divided by its equity. Its equity is 20,000, right? Because firm U doesn't use any or doesn't employ any debt, right? No debt financing there. So the whole capital, 20,000, is fully financed with equity. So 1,800 divided by 20,000 is 9%. What about firm L? How much is the net income again? This one? 1,080. 1,080 divided by its equity. And its equity is 10,000, right? 10,000. Because out of the 20,000 capital, it employs 10,000 debt. So the equity is only 10,000, right? So 1,080 divided by 10,000 is 10.8%. So you see here, this is an important fact, right? So the return on equity is higher for a levered firm. And this example is using, two identical firms, right? Almost identical firms, except that firm U is unlevered or doesn't use any debt financing, whereas firm L is using 50% debt financing, right? So you see, the return on equity is higher with this all the same numbers, except that firm L is financed with some proportion of debt financing, right? So profitability is higher. That's why we call leverage, or we call debt financing leverage, right? Because it could lever up the profitability of a firm, right? You see the proof here. Right? Okay, so if we calculate free cash flows, right, enjoyed by our investors, so we can check. So our investors in this example, our investors are consisting of only creditors and owners, right? In this example, we don't have like preferred stockholders, we don't have warrant holders or some other things. In this simplified example, so we have shareholders, right? Owners. So we can check for firm U, how much is it enjoyed by creditors? Zero, right? Zero. So we'll write it down, right? Creditors got zero, and shareholders got 1,800, right? So shareholders got 1,800. So total free cash flows enjoyed by investors for firm U is 1,800, right? Zero plus 1,800. What about firm L? How much is it enjoyed by creditors? This one, right? The interest expense. See? So 1,200, you see here. Okay, and then how much is it enjoyed by our owners or stockholders? This one, right? The net income. So supposedly this would be distributed as dividends or retained as retained earnings. So 1,080. Okay. If you sum them, you add them together, you get 2280. I see. So the levered firm offers more free cash flows to all investors, right, in combination, while the unlevered firm only provides 1800. Right? So again, this shows that this simple example shows that if there are two comparable firms exactly the same in terms of their operating profits, then the levered firm could create more cash flows, right? Could be more profitable. We saw the ROE or ROE before, right? And could provide more cash flows to investors, right? Investors mean creditors, shareholders, preferred stockholders, and other things. And what makes the difference here is this, again the interest expense, and uh, because of the interest expense, the unlevered firm will have to pay a higher amount of tax or taxes compared to the unlevered firm. Okay, so now what will happen if our expectation is not met, right? So again, we uh, cannot reach cannot attain the desired production or selling capacity. So this example, now we simulate a situation where the operating profit drops, right, from 3,000 to 2,000. Now you could imagine, right, uh, who will get a bigger trouble, right, from our previous uh, examples, right? If you have a lot of fixed costs and you cannot reach your production target or your sales target, then you will be in trouble, right? Because you have to cover a higher amount of costs, right, with respect to the fixed cost, because you have a higher fixed cost component or higher proportion of it. Okay, so we'll simulate a situation where operating profit is lower, right, from 3,000 to 2,000. So again, from you, it doesn't pay any interest because it's not employing any debt financing. So EBT would be 2,000, and with the tax rate of 40%, so the tax payment would be 800. Now the net income is 1,200. What about firm L? Firm L, we have EBIT is going down as well, 2,000, but firm L has to pay this one. So remember, right? 12% of 10,000 because it borrows 10,000, right? So the interest expense would be 1,200. So EBT would be 800 with the tax rate of 40%. This would be 320. And now the net income would be 480. So let's recalculate, right? Recalculate. How is the ROC, return on capital? Again, what is it? This is NOPAT, right, divided by the capital. That's why we call it return on invested capital. So net operating profit after tax divided by capital. So we find out again, what's the NOPAT here? 1,800 divided by capital. So 1,800 divided by 20,000 is 6%. No, sorry. So I have to revise this because now the NOPAT changes. Sorry. Yeah. So what is it again? This is NOPAT, right? Divided by capital. And what is NOPAT? NOPAT is EBIT minus tax, right? I will write it somewhere. So NOPAT, right? This is the ROC, NOPAT divided by capital. And NOPAT is net operating profit after tax, right? Okay. So divided by capital. So what is our new EBIT in the story for the firm U? 2000 here, right? 2000. 2000, and the tax rate is 40%. And what is the level of capital from you? Right, the capital is here at 20,000. Okay, so how much we will get? So, 1200. So it's 12,000 divided by 20,000. Okay, is yeah, 6%. 1200 divided by 20,000 is 6%, right? So yeah, here 6%. Okay, 6%. What about from L? From L, what is the EBIT? The EBIT is the operating profit is 2000 also, right? So same thing for firm L. The EBIT is 2000, right? Uh, Multiplied by 1 minus tax rate divided by what is the amount of capital for firm L here? Same, right? 20,000, right? Same 20,000, right? So exactly the same, right? So their return on capitals would be the same, right? 6%. Both are the same, 6%. But what about the ROI, return on equity? So what is return on equity again? This is net income per equity. So the net income, the new net income here is 1200. 1200 divided by the equity for firm U at 20,000, because the whole capital is financed with equity. Okay, so 1200 divided by 20,000 is 6%, right? What about firm L? Firm L, net income is 480, right? Divided by equity, right? The equity of firm L is 10,000 only, right? Because out of the 20,000 capital, 10,000 of it is debt financing. So 10,000 equity. So 480 divided by 10,000 is 4.8%. So you can see, right? In the previous case where the operating profit was 3,000, the profitability of firm L was higher, right? So uh, no, better ability to leverage the profit, right, to attain a higher level of profit. However, if the operating profit drops, right, to 2,000, now the performance, right, the profitability performance of firm L is below that of firm U. So it's more dangerous, right? So again, from these two examples, we could easily see that if you use more and more uh, uh, fixed cost financing like debt payment, right? So the use of debt here, the use of debt financing is some sort of like fixed cost, right? So it's uh, more perspective, right? Because if you use more and more debt, well, you pay, of course, uh, certain interest expense, but actually the total cash flows, total free cash flows that you provide to your investors exceed the level of from you, right, could produce. Okay, but if the situation turns sour, right, if the situation worsens, then you see the example here that the performance, right, profitability performance of firm L will worsen as well, will be even lower than that of firm U. So again, this is a situation that you can call higher risk, higher expected return. So if you're good at selling, right, you earn handsome profit, then the use of that actually benefits you more, right? Because you can lift up your profitability, right? But on the other hand, if your revenues target, your operating profit target is not met, right, and in reality is lower than your expected figure or your target, then you suffer more, right? Your profitability performance will suffer more than another firm with a lower level of debt financing or even without debt financing, like from you. Okay. So next one, now we'll see the capital structure theory. Capital structure theory, uh, we are going back a bit to the historical side of again the finance and economics. Capital structure uh, was one of the first themes or theories postulated in the wake of the finance field, in the wake of the emergence of finance. Okay, so as told in other videos, we know that the essentially the field of finance uh, was born in 1952, since Harry Markowitz published his paper on the portfolio selection. So that essentially has created a new field, right? A combined field within economics and accounting, right? So both forces are combined, right, into a new field called finance. So capital structure theory appeared not long after the publication of the portfolio selection. So this is considered one of the foundations of finance or financial theory. Okay, so we'll see the first one, the first theory. We call it the MM theory, right? So in 1958, so there were two people, famous people, who in the future would receive Nobel prizes. Right? There were Modigliani, Franco Modigliani, famous economist of the past, Modigliani and Merton Miller. So Franco Modigliani and Merton Miller in 1958 wrote the first paper on capital structure, and the paper uh, uh, is not an empirical paper because this is like a foundation paper. You can call them like founding fathers of the capital structure theory, or even finance, right? Because they were among the first economists that specialized their research on the financial economics and what we know as finance right now. So Modigliani and Miller in 1958, they wrote a seminal paper. Seminal paper. We call it seminal paper because this paper would be studied and discussed and put as a foundation in all capital structure research that we have done or will be doing in the future. So the theory again, uh, this is not an empirical paper, but it was full of mathematical lemmas and propositions, right? So it's still very difficult to read, even today, right? In today's standards, where we know more about mathematical, you know, what's that, formulas or calculus or anything with the improvement of technology, but this is still relatively difficult to read, right? So the model is called irrelevance theory. So this might ring a bell, right? Because in the dividend policy or dividend theory, we also know the irrelevance theory by these two people. So they call the theory irrelevance because this is what they find, right? Uh, they're saying that there's no connection, right? There's no relation between the capital structure and firm value. The capital structure decision doesn't affect your firm value. So what is the consequence of this statement? So essentially, they're saying that whatever capital structure mix that you are using, right, whether 100% equity or 100% debt or 70% equity or whatever, right, that will not affect the firm value, or it's not related at all to firm value, right? And we'll see why, right? Okay, so uh, uh, maybe before we go to the again the simulation, we have to know that the irrelevance theory was postulated with a lot of assumptions, and many of them were unrealistic assumptions. You see here, no transaction costs, no restrictions to short sales. Individuals can borrow at the same rate as corporations, right? There's no market friction and some other tight assumptions. So again, I have explained this in my video on dividend policy. So the use of unrealistic assumptions actually purport to really tie down a certain variable because we want to see the relation or the connection of that variable to a variable of interest. So without tight assumptions, we may not really know what would affect something, right? For example, in this case, firm value, right? So if we just, for example, regress the firm value on capital structure decision, but we don't create the tight situations or control situations or control variables, then you never know, right? Maybe there's a lot of like spurious result or uh, like the confounding effects of other variables, right? That accidentally or by chance affect the firm value, right? So again, I have explained this in the dividend policy video. So if you want to review that again, you can watch the video again. Okay. So again, the use of unrealistic assumptions will not damage the conclusion that is drawn, but actually, no. Again, the use, right, of unrealistic assumptions, it purports to really focus on a certain variable of interest, in this case, is the capital structure decision, and we want to know whether the variable of interest does affect the firm value, right? So we tie down the situations with all the assumptions, right? So maybe I can give you one example here, right? If we don't have this, uh, for example, we don't have the assumption of no transaction cost, and if we find out that capital structure has a positive and significant relation to firm value, but we don't control this one. So that the result might be affected by actually the transaction cost, right? So we never know whether somehow transaction cost uh, also affects or also uh, is also involved in the relationship between the capital structure decision and the firm value. That's why we tie all of this down, right? To make sure that they are not involved in in observing the relationship between the firm value and the capital structure decision. Okay, so we'll see why, right? The irrelevance theory. So we'll see again, coming back to a situation such as this one, firm U and firm L, unlevered firm with levered firm, right? So unlevered firm again is using no debt financing. So with a bit of 3,000 here, so firm L also has the same operating profit, right? So it pays no interest expense, right? So the implicitly here we know that the EBT is 3,000, and then the tax is uh, 0, right? No tax situation. So the net income, that's why the net income is 3,000. So this is the world without tax, right? You see the what's that? Uh, yeah, one of the assumptions, right? Again, this is unrealistic, right, in real world. But by doing this, we want to make sure that tax is not in the middle of the way, right? It's not in the way of observing the relationship between the firm value and the capital structure decision. Okay, so 3,000, right? The net income. What about this one, the firm L, right, with a bit of the same amount, right, 3,000. Now, let's say it borrows. I think from this is similar to the previous example, right? The 10,000 debt we just borrow from the previous example, right? With 12% cost of debt or interest rate, right? So 1,200, right? So the EBT is 1,800, and tax is 0 because this is a world without tax. That's why the net income is 1,800, right? 1,800 minus 0 is 1,800. So you see, in the world without tax, how much money is it? How much of the cash flows is enjoyed by creditors? For from you, 0, right? 0 here. What about the owners or shareholders? 3,000. So the total is 3,000 for firm U. What about firm L? How much is it enjoyed? How much are the cash flows, free cash flows enjoyed by creditors? Creditors, 1,200, right? The interest expense, right? Enjoyed by creditors. And how much are they enjoyed by owners or shareholders? 1,800, right? The net income. So if we total them, we get 3,000. This is what Modigliani and Miller said, right? So if you compare the total cash flows enjoyed by investors, they're just the same, right? No matter what capital structure mix that you are using, 100% debt, 100% equity, or anything, the total free cash flows enjoyed by our investors would amount to the same, would see the same amount, right? In this case, 3,000. Why? Because again, by tying down a lot of assumptions, including this important one, this is the world without tax, zero tax or zero taxes. So in the world without tax, without brokerage costs, right, without market friction, and without difference in interest rate between individual and corporate rates, right, then we find out that capital structure is not related to firm value because whatever capital structure mix that you are using, your investors will receive the same total amount, right? Okay, that's why we call it what? Irrelevance theory. So what is our conclusion here? So the value of the levered firm should be the same as the value of unlevered firm. So capital structure decision will not affect the firm value. That's why we call it irrelevance theory, right? So again, the value of the levered firm should be the same as the value of the unlevered firm. So capital structure is irrelevant. That's why we call this one again the irrelevance theory. Okay, so we'll continue our journey, right? In 1963, right? So Modigliani and Miller published another paper. So they came out again with the second version of the paper. That's why we call this paper MM the second. And this one you can call it actually MM the first. MM the first, right? Or Modigliani and Miller, right? So Modigliani and Miller the second, right? Second version. This was in 1963, and they relaxed one important assumption, right? So they relaxed one important assumption, that was the existence of the corporate tax. Okay, so the existence of corporate tax. Okay, so what's happening now? They included the corporate tax into analysis. You could imagine a corporate tax, okay, corporate income tax that we know, right? For corporation. So after the earnings before tax, we'll calculate the tax payment, right? Or the tax liability. Okay, so what is happening now with the appearance or existence of corporate tax? And we know that corporate tax has the benefit, right? That we saw in our previous example, an early example about financial risk. Now, with the existence of corporate tax, they're saying that the corporate tax does bring tax shield or tax benefit. So the conclusion of MM the second is we should use 100% debt. Wow, this is quite extreme, right? So in MM the first, in the first paper, so they were saying that capital structure decision was irrelevant, right? So they call it irrelevance theory. In the second paper, they're saying that with the existence of corporate tax, now the tax benefit is so big, right? It provides a tax shield or tax benefit so that a company should use, if possible, 100% debt financing. Okay, so I think we can go back to the previous example, right? Okay, here you see, yeah, the firm L, right? Even with 50% debt, 50% debt only, so 50% equity. So with the existence of corporate tax here, see, the tax payment that would be incurred by levered firm would be lower than the unlevered firm, right? So you can imagine if we use maybe 70% debt, and of course the tax payment would be lower. And if we use 80%, it will be lower again and again, right? So the higher the proportion of your debt financing, the lower the tax payment that you will incur, right, or pay, right? And what is the consequence here? The consequence shows that the total amount of money enjoyed by investors will be higher and higher because you pay less and less tax or taxes, right? So you can imagine this is a simple example, right? 50% debt with zero debt. And this example, the total free cash flows enjoyed by investors is 2280, whereas for the unlevered firm, it was only 1800, so it's more than this one. So you can imagine if you use more and more debt financing, then the total cash flows enjoyed by the total investors would be higher and higher because the amount of tax or taxes that you pay will be lower and lower. You got the idea, right? So if you use a higher and higher debt financing, then the tax payment that you will have to incur will be lower. And consequently, the total cash flows enjoyed by your total investors would be higher and higher. Okay, so that's why MM the second, you see here. So what is the value of, now what is the value of the firm now. So the value of is saying that value of levered firm now is equal to value of unlevered firm plus the tax shield. Right? Tax shield means the tax rate multiplied by the amount of debt. Right? So you can imagine, right? So the value of levered firm should be a function of the value of unlevered firm, plus tax shield. Right? Tax shield is, again, this is a tax rate multiplied by the amount of debt that you have. So what is the conclusion here? If you use more and more debt financing, this will be more, right? So this concept, right? This model, the MM, the second model, wants to say that the higher the debt financing, the higher the value of the firm. So if possible, what's the recommendation? If possible, use as high debt financing as possible, and if possible, 100%, right? So you see the figure here. This is the value of unlevered firm. So if you use debt financing, right, more and more, you increase your debt financing, right, the level of debt here, then the value of the firm will increase, right, because of the tax shield. Right? Okay, so this is the what's that, recommendation, conclusion and recommendation by MM the second, right? MM the second. So it's recommending like as high debt financing as possible, and if possible, 100%, right? Okay, so next one, right? In 1969, right? 1969, Miller appeared again, Merton Miller, by himself. So we never call this one MM the third, right? Because only Miller appeared, right? So this is not MM the third, okay? Only Miller appeared. So what was he saying in the third paper? No, actually, not the third paper of both of them, but his paper in 1969. So he included one more factor. So remember in MM the second, we already had corporate tax, right? So in Miller's 1969 paper, he included personal tax. So now we have two taxes, right? Two tax types here: the corporate tax, right? Corporate income tax, and now personal income tax. Because remember, our creditors and our owners also have to pay their own personal taxes, right? So now we include the personal tax. So what are we saying here? It's very interesting, right? So I will start from the conclusion of this paper. So this paper concludes that uh, the use of debt financing is still very beneficial, and it still recommends that you use as high debt financing as possible. However, with the incorporation of personal tax, or the inclusion of personal tax, the benefit from debt financing is not as high as what imagined or postulated by MM the second. Right? Interesting, right? So essentially, Miller is saying this. Right? So the conclusion remains the same. If you use higher debt financing, then the value of the firm will increase. However, the benefit conveyed by the debt financing is not as high as what expected or what postulated by MM the second. Right? So we'll see the logic here. So saying that the interest expense that we pay to our creditors, right? So to them, this would be called what? Interest income, right? Interest income, right? Okay, so interest income would be taxed at your bracket, right? In the US, in the United States, you will be taxed at your issue at your bracket, right? In other countries, it would be different, right? For example, the bond, uh, bond interest income would be taxed at different rates in different country. So, for example, in Indonesia, uh, bond interest income would be taxed at 15%, right? So, uh, yeah, other types of debt would be taxed differently. So it depends on on the location, right? But again, this is the norm, right? So we are following the, for example, in the United States. So this would be taxed at your as your ordinary income, right? Interest income by the creditors. What about the net income? So the net income would be given to your owners, right? Your shareholders in the form of what? First possibility is dividends, right? So if you watch my video on dividend policy, so you know that uh, dividends will be taxed at your bracket according to your tax bracket, right? So it's quite expensive. If you are at a higher and higher bracket, then receiving dividends would be quite painful, right? Because you pay a higher amount of tax because of the bracket, right? Another example in Indonesia, dividend income tax would be 10% for individuals, right? So not that high, but still, right? Yeah, 10% of the income. Second possibility is you save the money, right? So again, out of the net income, some of them will be distributed as dividends, right? Some of them would be saved or retained as retained earnings or corporate savings, right? And then you use the retained earnings to expand your business, right? To reinvest, to enlarge your projects or anything. And if those projects, if your ventures are successful, then your stock price will increase, right? And the increasing stock price will create what? Capital gains, right? So if the owners are patient enough, they will wait for this, right? They'll be willing to receive like less dividend, and the money could be reinvested. And if again, if the projects or again the efforts are successful, then stock price will increase, and they will enjoy capital gains. And capital gains, if you hold the stocks below 12 months, then it will be treated as an ordinary income. So you follow your tax bracket, right? But if you hold the stocks more than 12 months and you get capital gains, then the tax rate is between 0 to 20%. So it could be zero if your taxable income is not that high. It's quite interesting, right? And again, in Indonesia, the capital gains tax is about 0.1%. So still lower than dividend, right? Anywhere in the world, I guess. So we see the logic now. So uh, so Miller is saying, right? So receiving uh, or maybe I rephrase my statement. Being an owner is not as bad as what we imagined before, right? Because now we have this possibility, right? When we incorporate uh, the personal tax into analysis, right? So we always say that the interest income is usually taxed uh, more mildly than the dividend, right? Than the dividend income tax, right? But with the existence of the capital gains, now you see that actually this could be quite interesting, right? Especially for the long-term holders, right? Long-term owners. And the capital gain tax would be relatively low. And this is quite interesting, right? So in other words, we are saying that being an owner is not as bad as we imagined before, right? Because in the second paper, right, the the second, we're saying that the use of equity, like maybe zero debt or 100% equity, will not give you any uh, tax benefit, right? Will not give you any, again, the tax shield. That's why the second, we're seeing that uh, the more important thing there is the tax shield, right, provided by the debt financing, because you use more debt, you pay more interest expense and less tax payment, right? But Miller is saying that by observing from another side, which is the personal tax perspective, now we are seeing that being a stockholder is not as bad as what we imagined before. Because if you are patient enough and you choose to be a long-term owner or stockholder, then you could expect to get a capital gains tax of between 0 to 20%, right? So it's relatively low, not as bad as what we imagine. So again, what's the idea of Miller, the Miller paper here, Miller 1969, is that uh, the use of debt financing is very beneficial still, right? And he still recommended that the value of the firm will increase, right, with the increase in debt financing. However, what he was saying is that the tax benefit from the debt financing is not as high as what we imagine in the MM the second, or what was expected by MM the second. Okay, so we see here. So now the value of the firm is a function of now value of unlevered firm plus one minus this is the corporate tax rate, right? Corporate tax rate. So the after EBT, right? After earnings before tax, this is the tax rate that will be charged on the EBT. So this is the personal tax rate on dividend, right, or capital gains. So personal tax rate on stock income. So this is personal tax rate that will be charged on stockholders. And this one is TD, right? Personal tax rate that would be charged on the creditors, right? Because they receive the interest income. Okay, so this is corporate tax rate. This is the tax rate that will be charged on stockholders. This is a tax rate that will be charged on creditors, multiplied by the amount of debt. Okay, so one more time, right? So the value of the firm is still increasing with the use of debt, right? So again, Miller was still recommending that a firm used as much debt as possible. However, this model is saying or is showing that the benefit from debt financing because of the tax shield, because of debt financing, is not as high as uh, that expected by or postulated by MM the second. We can put an example here. If the corporate tax rate is 40%, if the tax rate charged on owners is 12%, and tax rate charged on creditors is 30%. So it will form this function, right? For this is an example, right? So conclusion, with the personal taxes, this one, right? The Miller 1969. So debt financing remains advantageous, but the benefits are less than uh, you know less than that expected or imagined by MM the second, right? So other theories that we could see here, trade-off theory, trade-off, right? Trade-off means we have a trade-off, a dilemma for the debt financing, right? On the one hand, uh, what's the debt financing looks like, right, a leverage, right? It could leverage your profitability, right? We have seen some examples today, right? How the use of debt financing could leverage our profitability, and uh, it will also give you tax benefits, right? We saw the previous example. If you use more and more debt financing, then you pay more interest expense, and consequently, the tax payment will be lower. And again, consequently, the total free cash flows enjoyed by investors will be higher, right? But on the other hand, the negative side or negative, the drawback would be the bankruptcy costs, right? This is the negative side of debt financing, the bankruptcy costs, right? So it's just like see, this is very important, an interesting figure, right? So you could think about or use another analogy, like for debt financing. It's very similar to eating meat in your life, right? So if you don't eat meat at all, it's just like you don't want to use any debt financing, so you use zero financing. So what is the consequence there? You use zero debt financing, your growth rate might be lower, right? Because you rely on only equity, right? So equity only financing means that if you have some business ideas, some technological ideas, you have to wait, right? Wait until you have enough equity to finance the project, right? And who knows, when you have enough equity to finance the project, the momentum has gone, right? Or the idea has been executed by your competitors or something like that, right? So uh, it might be too late, so the growth rate will be low, right? So when you start using debt financing, it's like you start eating meat, right? So you have the protein, right? The animal protein, right? You go healthier, right? Of course, you are healthier if you eat meat, right? Than eating no meat at all. However, this is an important point, right? When you reach a certain optimum level, right? Optimum level there, keep adding that would be detrimental. So it doesn't give you additional benefit, but on the other hand, or on the contrary, actually you're creating damage, right, to the firm. So it's very similar to, again, our analogy of meat eating, right? If you keep eating meat uh, beyond a certain optimum level, then the meat that you eat would be detrimental to your health. So it's not healthy anymore, right? But you see my point here, to explain the trade-off theory. When you start using that, then your company prospect will be higher. So you increase the prospect and you increase the growth of your firm, because now you have money available to execute your projects quickly, right, or right away. But if you keep adding that beyond a certain optimum level, then that would be dangerous, right? That would be detrimental, because now the distress costs, or the the bankruptcy costs will outweigh your debt financing benefits, right? Like tax shield, or the good growth rate, uh, big growth rate that you are enjoying. And similarly, right, when you eat more and more meat, right, beyond a certain level, certain optimum level, then the additional meat eating will not add to your health, but on the contrary will damage your health. Okay, so that's the trade-off theory. So we need to find an optimum level, optimum capital structure, right? That we'll see later in this video. Okay, now signaling theory, right? Signaling theory. This is always interesting, right? If we see signaling, again, in the dividend policy discussion, we also saw the signaling theory, right? That it conveys signal, right? Your action conveys signal. So I think here's the logic, right? If I ask you, if you have a best friend, right? You have a best friend. Well, my simple question would be, uh, how deep do you actually know uh, the thought of your best friend? So let me rephrase my statement, right? So if you are asked honestly, right, how much do you really know your best friend? You might answer maybe 50%, right? 60%, or maybe some people would reply like 20% only, or 25%. So nobody would answer 100%, right? Because you never know, right? You never know the uh, thought, the real feeling, right? Again, the real thought of even your best friends. Right? So what can you do? You can only read signals, right? Signals come from what? From their actions, right? If they, for example, if they show no interest in watching certain movies, right? Certain types of movies, then you know that they don't like something, right? That's a signal, right? Or if you go out with your best friend and you find out that she never chooses a certain menu, then you know that she doesn't like certain food, right? So that's signals, right? Those are signals that we can read, right? So we can only read signals. We never know, no, the real thought or the real situations, including in a corporation, right? So we never know what is really going on in a firm, right? In a company. What we can only do is to read signals given by the company through the corporate actions. Okay, so one of the important decisions that they continuously make is the capital structure decision. So this conveys a strong signal, right? A strong signal. So uh, now just follow my logic here. Okay, so we have let's simplify the situation. We have debt financing, we have equity financing, right? So if we need money, so we will either raise more debt or raise more equity or both, right? Could be both as well. But let's say they are mutually exclusive, so you have to choose. So let's imagine a situation, right? Let's say you see someone, right, and it turns out that you like this person, right? Maybe a girlfriend or a boyfriend. No, sorry, a potential girlfriend or potential boyfriend. So you like this person, right? So imagine the situation, like so you start calculating, you start calculating how deep your relationship could be with this person. So based on your calculation, you're seeing a high possibility that this person could be your partner, right? Could be your boyfriend or your girlfriend. So now think about it, right? If you decide to go to this person's house, right? You want to just go to his or her house to ask him or her out, right? Simple question, right? Will you go alone or will you ask another friend to accompany you to go to that person's house? If you, if based on your calculation, you believe that you have more than 75% chance of getting this person, of course, you go alone, right? You go alone because, well, your estimation, your measurement shows you that you have a higher chance, right? A very high chance of approaching this person. So you go alone, you execute it alone, right? So what about the second possible scenario? Uh, so based on your estimation and your calculation, the chance of being close or getting this person is only, let's say, 40%. So it's even below half, right? Below 50%. So it's only 40%. So if you decide to check out, this person by going to this person's house, right? Uh, just to communicate more and some to build more communication. Will you go alone, or is there any possibility that you ask someone else to accompany you? And I would say the second possibility might persist, right? Might prevail. So in this situation, you try to minimize your risk, right? If something happens, you don't want to be embarrassed, alone, right? So you want someone to accompany you to share the risk, right? To share the embarrassment. Okay, if something happens, it turns out that this person doesn't show any interest. If you go with another person, you have an alibi, right? You say, oh, we are going there just for a business talk or whatever conversation, right? General conversations or something like that. Okay, so you see, so we come back to this discussion. So between debt and equity, especially new debt or new equity, signal conveyed by debt financing is always better. Why? Because you imagine, right? if you suddenly increase your debt financing, so all the investors and even your competitors will start seeing the situation where they're guessing, right? They're what's that? Uh, yeah, they're estimating or guessing that you have something bright, right? A good prospect that you don't want to share with other people. Because debt financing, you see, you borrow from your creditors, and your creditors are not the owners of the company, right? They're only creditors. Of course, creditors are part of investors, of course, right? But creditors are not owners, right? But if you suddenly, increase your equity financing, you issue new shares out of the blue, right? People would be very suspicious, right? Because they'll start thinking, why are you so kind, right? To invite other people to become owners, right? Because you sell this to new owners, right? Okay, they'll start. They will be perplexed and start questioning, right? Why you are so kind to invite other people to be owners? And they might be suspicious in the sense that uh, no, you might invite other people to share the risk, right? To share the embarrassment in our example, or to share the risk, right? Potential risk. So this could be interpreted as a high risk situation because uh, you're suddenly willing to invite new owners into the company, right? So they will be quite, perplexed and suspicious, right? So they would think that you want to share the risk with them, right? So again, between the debt and equity financing, debt equity conveys a better signal, right? Because they would once again they would think that you have a good prospect, right? You have uh, like big projects ahead, but you don't want to share the ownership with people. That's why you borrow more money. Okay, so this is called the signaling theory. So you keep giving signals to the market, to your investors, and also potential investors. Next one, pecking order theory, right? Pecking order. So as suggested by the name, you see, pecking order. So you try to order something, right? Order to make a list or order from the easiest to the more difficult ones. So let's imagine you have debt financing, right? And then you have preferred stock, right? And then you have common stock. So you have the common equity, the existing one, and then you have new equity, right? New common stock. Okay, so if you need money, according to the pecking order theory, you make an order, right? From the easiest one to access to the most difficult one to access. So what is the easiest one to access if you need money, according to pecking order theory? Of course, what? Of course, the savings that you are having, right? Right. This is your existing one or retained earnings, right? Okay, so you if you need additional money or you need money to execute projects or expand businesses or something like that, you will always start from the easiest one to access. That is your savings, right? Your retained earnings. Okay, so this one is called what, internal financing, right? Internal financing. So according to the theory, right, the pecking order theory, you try to use as much internal financing as possible before looking for external financing. Okay, so once again, this is not ordered from the cheapest to the most expensive, but the pecking order theory is ordering from the easiest to access, right? The easiest to access to the most difficult to access. So retained earnings, internal financing is the easiest to access, right? And then if it's not enough, then we'll start using external financing. Okay, if not enough, then we start using external financing. Now starting from what? From debt, right? Debt financing, and then preferred stock, and then of course new stock, right? New common stock or new equity. Okay, so we start from internal, and if it's not enough, then we start with then we look for external financing, starting from debt, right? Because debt is, and not only not only is it the easiest, but it is also the cheapest, right? So external easiest and the cheapest, and then preferred stock and the most difficult one or the most complicated one, and also the worst signal, right? Which is the new equity financing or new common stock. Okay, so maybe another perspective about the debt financing is regarding the agency cost, right? So the use of financial leverage, see here. So you force, so this is the benefit, right? One side, right? If you force your executive, you were an owner and you try to force your executive to use more and more debt financing. What's the main benefit? The main benefit would be lower agency problem because now your management or your executive would be constrained by the interest expense and principal repayment that he or she has to uh, manage, right? Okay, so the CEO, the CFO, and okay, the executive team would be very busy managing the cash flows so that they could fulfill and they could repay the debt, right? So they don't have uh, they don't have a lot of opportunities to waste the money. Okay, so that's the positive benefit. So we could reduce the wasteful behavior, wasteful action by your top executive because now they have to make sure that they could repay the interest expense and also the principal of the debt. Otherwise, uh, the company could be sued by the creditors, right? Could be taken to court and could be sued for bankruptcy, and then the top executive will lose their jobs. Unfortunately, this decision has a downside, right? Has a potential drawback that we call underinvestment. So you see again the benefit of doing this, right? The top management would be more disciplined, right? Uh, they'll be more careful in using cash flows because now they have to manage the cash flows well. They have to repay the debt, right? But on the other hand, this might create you know, fear situation. I fear. So you build fear uh, in the team of executive and management. So they would be like over focused on their ability to repay the debt. And for example, if there is a potential investment coming up, right? This is quite potential, but they will start or they'll keep thinking about the use of cash flows, whether they should invest in this venture or not, because they are afraid, right? They fear for uh, their inability to fulfill or to repay the debt. So they might forgo, right? They might let it go because they're more focused on again the debt repayment. So this is not good either, right? This is just the other side of the story, right? But the bad side, a negative side of the decision, right? So if you force again the executive to use too much debt, this situation might prevail, right? The underinvestment situation. So they'll forego a lot of potential projects or positive NPV projects because they prefer to focus or fulfill their liabilities, especially with respect to the debt repayment. Another theory, market timing theory, right? So you try to time the market. You find out that the market is good, the equity market is good. Maybe you want to consider issuing more stocks, right? But if the market is bad, right, such as these days because of the healthcare crisis, uh, then if you issue your equity right now, most likely you get like a very low price in your initial public offering. So this is also relevant, right, to the practical life, right? Market timing theory. Have to observe the timing, the momentum of the market, right? So if the equity market is not that good, then we have to rely on the debt market, right? And vice versa. So empirical evidence here, you see, the financing, debt financing does add value to the firm based on the research findings, okay? But of course, it's uh, uh, not absolute, right? Cannot generalize maybe the findings to all countries, but I think the logic is quite relevant everywhere. Right? If we start adding that into capital structure, then we'll get benefits, right? However, we have to be careful with the optimum level that we want to reach, because beyond that optimum level, the additional debt financing would be detrimental, right? Would be detrimental to the firm, because the bankruptcy costs would outweigh, right? Would exceed the benefits delivered by debt financing. Okay, so again, we see a lot of empirical evidence. Uh, what are the implications? So take advantage of tax benefits. If your firm is this kind of firm, see, high tax rate, right? High tax rate. So again, you could reduce your tax payment by increasing your debt financing because you pay more interest expense, right? Or if you have stable sales, quite safe, right? If you have like good sales and they are stable, so you can be convinced that you could fulfill your obligation, right? Your uh, interest expense and also the repayment of the principal, right? And low operating leverage. So you still have like considerably low or stable use of fixed costs, other types of fixed costs apart from the interest expense. And avoid financial distress. So you should use less debt financing if your firm has like volatile sales, right? It's quite uncertain, because if you don't make enough sales, then you cannot fulfill your obligation, right, to repay your debt, right? Or high operating leverage, you see, high use of fixed costs, right? The dole, high dole, right? High use of fixed costs. Or if you have this one, many potential opportunities. So it is suggested that if you are a firm with a lot of investment opportunities, you should keep the borrowing capacity. So you don't want to max out too soon. But here's the logic, right? If you have a lot of investment opportunities, and should the opportunities suddenly arise, uh, you want to have now the ability to borrow quick to get quick borrowing, right? To execute the opportunities. But if you max out, you are maxed out in your borrowing capacity, then you don't have a new opportunity to borrow money. Then you have to rely on equity financing only, right? So again, it's suggested that uh, if you're a firm with a lot of investment opportunities, then it's better to keep a certain level of borrowing capacity rather than max it out too soon. Or you have like special purpose assets that cannot be used as collaterals, right? This would be very difficult to get borrowing, right? Uh, for example, if your business has a lot of like buildings or the common assets, they would be very easy to put as collaterals, right? Everybody, every potential creditor would take buildings as collaterals or vehicles, something like that. But if you're a company having like maybe healthcare equipment, right? Healthcare equipment in the labs or something, right? So if you want to borrow money and you put them as collaterals, I'm not sure there are many creditors or many financial institutions are willing to take those kind of assets as collaterals, because if you don't pay the debt, then they will confiscate the lab equipment, and they'll find a big difficulty selling them, right? Like the needles or something, right? Okay, so I think that's the discussion on can the empirical evidence, right? Okay, we have a lot of new evidence, right? So the average speed of adjustment you can see here, right? So speed of adjustment, right? Uh, they don't make, see here, they have target capital structure, right? Firms have target capital structure, but they don't make quick correction, even when stock prices or their stock prices change. That will cause their debt ratios to change as well. So they don't immediately change their capital structure, although they have the target, right? They know the target, but even if they see like the stock price changes and the debt ratio also changes, but the company doesn't make a quick corrective action to fulfill the target. So very interesting research finding, this one, right? Okay, so the last part of our discussion today would be about the optimum capital structure or the optimal capital structure. So what is it? So optimal capital structure, right? So you see again, right? This is the value of the firm. You have free cash flows in the future, discounted back at the cost of capital, or the required return by investors. So an optimum capital structure is a capital structure that could maximize the value of the firm, of course, right? That's why we always relate capital structure decision with the firm value. So an optimal capital structure is the one that could maximize the value of the firm. Or in other words, the optimal capital structure is the one that could minimize the cost of capital. Just the same meaning, right? This is the numerator, this is the denominator. So once again, right, an optimal capital structure is a capital structure that could maximize the value of the firm, or the one that could minimize the cost of capital. Okay, so let's see an example now. So we have a hypothetical situation. Beta of the firm is 1, right? Beta of the firm. Risk-free rate is 6%, and the market risk premium is 6%. So you can guess quickly, right? We know this information definitely is for the use of CAPM, right? Capital Asset Pricing Model, to determine the cost of equity. Okay, so using CAPM, we estimate the cost of equity here. Cost of equity is the required return by stockholders, right? So risk-free plus a beta multiplied by market risk premium, right? So 6% plus 1 multiplied by market risk premium. So market risk premium is RM minus RF, right? So market return minus risk-free return. So it's 6%, right? It's already known or informed. So the cost of equity is 12%. So first scenario, right? The first scenario is zero debt policy. Zero debt policy. And of course, because you have no debt, then your cost of debt is 0%, right? So you put into put into the weighted average calculation. Of course, the weight of your debt is nothing, you use no debt, then your cost of equity is entirely comprised of the cost of equity. So the cost of capital, your cost of capital is entirely comprised of the cost of equity only, right? Because you have no cost of debt, right? Okay. And the tax rate is informed at 40% in this case. So we're going to simulate using the the constant growth model, a constant growth forever model. This is a simplification, just to prove a case here, just to show how the optimal capital structure works. So we don't have the focus or intention to show how to estimate the free cash flows correctly. So this is just following the constant growth forever method, right? Constant growth forever model. So let's see the zero growth, right? No growth anymore. Okay, so the value of something. So according to the constant growth forever model, so the value of an asset would be the next cash flows. So we are here, right now. So next cash flow would be next, right? If we are at the time zero, the next cash flow would be 1. Next cash flow divided by the cost of capital minus the constant growth forever. Okay, so in our example, the current cash flow is 30 million, right? So the next one would be, so the current free cash flow is 30 million and the growth rate is 0%, right? Zero growth, okay? Divided by, what is the cost of capital again? 12%. We saw it in our previous slide, minus the constant growth forever. Okay, so again, this is a simplified example, okay, just to prove a point. So 30 million growing by 0%, and the constant growth forever is 0%, right? Divided by the cost of capital, 12%, minus the constant growth forever. Okay, we get 250 million. Okay, 250 million. And these are additional assumptions. We don't have any short-term assets like marketable securities or even cash, right? No preferred stock, and there are 10 million shares outstanding. Okay, so we put into analysis here. So value of operations is 250, calculated before, right? 250. No short-term investments, right? No marketable securities or additional cash. So the value of the firm is 250. Now, this is a company, this is the first scenario, zero debt, okay? Zero debt. So the value of equity would be the same, right? Would remain at 250. And there are 10 million shares outstanding. 10 million shares outstanding. Okay. And if you divide the total equity value by the number of shares outstanding, then the stock price is estimated to be 25 a share. Okay, so this is the first scenario, right? First scenario means that there is no debt, right? Zero debt. Okay, so now we'll go further to many other scenarios, right? So now the second scenario, okay? So the first scenario shows that we assumes that we have no debt, right? No debt. If we have no debt, then the cost of equity would be zero, okay? Now, the second scenario, so we'll try the second scenario. We start using 20% debt, right? And of course, with the existence of debt financing, you start having the cost of debt, right? So how to determine the cost of debt? You have to watch my video on cost of capital. There I discuss in more details about the cost of debt and how to estimate the cost of debt. But suffice it for now to assume that if we use 20% debt and you ask your potential creditors, they give you a quote, right? They give you a quote that they will charge you 8%. Okay? So if you use 30% debt, they will charge you at 8.5%. Of course, it's higher, right? The more debt financing, the more proportion of debt they are using, uh, the higher the interest charge that they will put on you because your situation is becoming more and more dangerous or risky, right? It's riskier for the creditor. So if you use 40%, they will charge you 10%. And of course, if you use more and more, they will charge you more because you are riskier, right? Your situation is riskier. Okay, so we try to move to the second scenario, right? The 20% debt, right? So we have to adjust as well. So this is a very important concept, right? The Hamada's equation. Hamada's equation. So here's the logic, right? So previously we already knew the beta of the firm, right? The systematic risk, right? So I discussed beta a lot in my videos on portfolio theory. So there are three parts there about portfolio theory. So you can go there to review about the beta. So it was informed to us that the beta was 1, right? 1.0. And this beta was found when we use no debt. Okay, so this is very interesting concept, right? So so the beta that we are having only holds when the capital structure is maintained or is static. Okay, so we don't change the capital structure, then the beta will hold. For example, we know that the beta is 1.0 if we use what 0% debt and 100% equity. So this is the idea. Okay? So if I change it to like 20% debt and 80% equity, then we cannot assume that the beta will remain 1. No, right? So we cannot do that. So we have to re-estimate the beta, right? Because now there's a change in capital structure. So the riskiness of the firm has changed, right? Previously, we used no debt, zero debt. Now we increase the debt financing to 20%. So it's riskier. So it's riskier to creditors as well as to equity holders. So we cannot assume that the beta or the systematic risk will remain as it was when it's at 0%. That's why we need the thanks to Hamada, right? Researcher named Hamada uh, uh, found or made this formula, right? This is Hamada's equation, right? So we need to adjust, right? This is the levered beta, right? Levered beta. So this is a function of unlevered beta. Unlevered beta is the beta when we use no debt, right? In our example, this would be what? This one, right? Beta when we use no debt, right? So unlevered beta, okay? 1, right? Multiplied by, so I think we will, we write it right away. So 1 multiplied by, this is 1, right? See this again, right? The beta was 1 when we used zero debt. We call it what? Unlevered beta. Multiplied by 1 plus 1 minus tax rate. Right? In this example, we were informed that the tax rate is 40%. Okay, multiplied by, this is the debt to equity, right? Debt to equity ratio. So the second scenario is this one, right? 20% debt. And of course, if the debt is 20%, then the equity is, of course, 80, right? Debt to equity ratio is 2080. Okay, and then we get, so the beta would be, yeah, 115. See here, this is the unlevered beta that we saw, right? Multiplied by 1 plus 1 minus tax rate, multiplied by the debt to equity ratio, right? Debt to equity ratio. So we get the new beta, right? So now we find out that the when the 2080, the beta would be 115. Okay, so this is very important concept. You cannot just apply the beta for the whole capital structure changes. So we have to divide one. We have to define each beta for each capital structure configuration or mix. Okay, so we use the beta, right? When the debt ratio is 20%, the beta is 115. So we put in the CAPM again to re-estimate the cost of equity. So cost of was it the risk-free from, I think, from the beginning? Yeah, here early assumptions there, 6%, and the market risk premium is 6% also. So risk-free is 6% times the new beta. The beta when the debt ratio is 20%, right, multiplied by market risk premium. This is RM minus RF, and it's known, right? It's the information is given. That is 6%. So the new cost of equity is 12.9%. Okay, this is the cost of equity when the debt ratio has increased to 20%. So now we need to estimate the cost of capital, right? So now we are using what, 20% debt, right? Multiplied by the cost of debt is here, right? So we ask our potential creditors, right? And they're giving you a quote, right? They tell you that they will charge you 8% if your debt ratio is 20%, right? So we know it from there, right? So 8%. And of course, the cost of debt is tax deductible, right? Tax deductible. And if you miss this part or this logic, go to my video again on cost of capital. I explained it there, right? So again, 20% multiplied by the cost of debt, right? Is 8% multiplied by 1 minus the tax rate. So this is a tax deductibility. So plus the cost of equity. So this is the proportion of equity. If the debt ratio is 20%, of course, the proportion of equity is 80%, right? Multiplied by the cost of equity that we found in the previous slide. So the new cost of equity for the 20% debt ratio is 12.9%. So we get the new cost of capital here. So this is the cost of capital when the debt ratio is 20%. Okay, so we continuously repeat the process, right? So remember, when the debt ratio is 0%, the cost of equity is 12%. Let's go back there to show a point here, right? No debt, and we have estimated that the cost of capital is 12%. So when, again, one more time, when the company employed no debt financing, the cost of capital was 12%, right? But when the company starts using 20% debt, right here, 20% debt. The cost of capital is, sorry, here, when the company starts using 20% debt ratio, the cost of capital is 11.28%. Then we repeat the process again, right? We don't show it here anymore because it will be too long, but you repeat the process. You can try it by yourself, right? If this is 30%, if the debt ratio is 30%, the cost of capital would be lower even, right, at 11.01%. If the debt ratio is 40%, the cost of capital would be 11.04 and so forth, right? If it's 50%, then the cost of capital would be 11.40. So you see a pattern here, right? So when you start using debt, you start adding debt into your capital structure, the cost of capital actually declines, right? Good news, right? Right? It's declining, right? Declining. And it declines further, right? But after this, after this mix, right? This 30-70 mix, actually, if you keep adding debt financing into your capital structure, the cost of capital increases. Now not good anymore. So what is the what's that? The capital structure mix that give you the lowest cost of capital? This one, right? That's why in this example we are saying that 30%, 70% is the optimal capital structure, right? 30% debt and 70% equity, because we are at this point, right? When we added debt, the cost of capital declined, right? But after reaching the 30% debt ratio, actually the cost of capital then increases, so not good anymore. Okay, so again, optimal capital structure is the one that minimizes the cost of capital, right? Or the one that maximizes the value of the firm, right? The value of the firm. So we'll try the other way, right? So again, the optimal capital structure we have proved from one side, right? Is the one that minimizes the cost of capital. But now we want to prove the other side, that is the capital structure that maximizes the value of the firm. I think we calculated before for the first, right? For the first alternative, right? When we used zero debt, right? When we use zero debt, the value of the firm is 250, right? So we'll continue this procedure to the next, again, to the next next alternative. The second alternative would be 20% debt, right? We can try it. Okay, now here, 20% debt, right? So we use again the what's that? Constant growth forever model, right? So again, the value of the firm would be this is the constant growth forever model. So next cash flow, right? So next cash flow divided by cost of capital minus the constant growth forever. And this is just the same as the current cash flow that grows by constant growth forever, right? Divided by cost of capital minus the constant growth forever. So this is the constant growth forever model, right? The simplification of the case, right? So again, what is the existing cash flow is 30. 30 growing at, what is the constant growth forever in the story again? 0%. So the constant growth rate is 0%, right? Divided by, so what is the cost of capital when we use now the 20%, 20% 20% debt, right? What is the cost of capital again? Okay, here, this one, right? Okay, or you want to see it in a table, you can see this one, right? So the cost of capital when we use 20% debt is 11.28%. Minus the constant growth forever in the story is 0, right? And let's see how much we'll get. Sorry, where is it? Yeah, here, right? 265.96 million. Okay, 265. And of course, if you want to split it in details, we know that 20% of it would be in the form of debt, and 80% would be in the form of equity, 53 and 212 respectively, right? If you want to split it in the details. But the essence is this one, right? 265, the total value. And previously we saw that when it used no debt, the value was 250, right? When you use 20% debt, the value is 265.96. So you can repeat the procedure, right? To 30%, 40%, 50% debt ratios, okay? And you get 272, 271, 263. So you're seeing the same pattern, right? When you add in the beginning, when you add more debt into your financing mix, the value of the firm will increase, right? It's increasing. And then you add more to 30% debt, it increases even more. However, when you add the debt financing to 40%, actually the value of the firm declines, right? Starts declining and will continuously decline. So the optimum capital structure prevails or happens when you use 30% debt and 70% equity. So this is congruent or in line with the cost of capital, right? So again, one more time, an optimal capital structure is the one that maximizes the value of the firm or the one that minimizes the cost of capital. So they are just in line or they're corresponding to one another. Okay, so it's quite intensive discussion today. We have seen a lot of things about the capital structure decision, and this remains important. People keep searching, right, for the optimal capital structure. Many people still believe in, again, the optimum capital structure. This might evolve into newer techniques, newer instruments, right, newer financing alternative, and yeah, so on and so forth. Okay, so thank you very much for bearing with me today in discussing the capital structure decision and capital structure theory. Hope it benefits you and would be useful for your practical world and also your academic research and something like that. So thank you and see you next time.